It's a Tuesday morning in Munich. Coffee's still steaming, you open your Comdirect app, and your portfolio is green. Siemens is up. SAP recovered. That small Infineon position you bought last autumn is showing a gain. You feel like someone who figured it out. And then there's Thomas. Thomas is doing the same thing you're doing, except he isn't. He buys one ETF every single month. He picks no stocks. He reads no earnings reports. And after 25 years, Thomas will have approximately €340,000 more than you. That sounds wrong, but it's just math. Let's make this fair. You and Thomas, both 35 years old, both earning around €55,000 gross per year, roughly the German median wage. Both investing €500 per month for 25 years inside a regular German depot account. The only difference is the strategy. You pick individual stocks. 7 or 8 names you know well.
DAX giants like Siemens, Deutsche Telekom, Münchener Rück.
Maybe a growth bet or two, Infineon, a renewable energy play. You spend 4 to 5 hours a week on financial news, finanzen.net, and earnings calls. You treat it like a second job. Thomas opens an account at DKB and does something almost embarrassingly simple. He buys the iShares Core MSCI World ETF every month. No thesis, no conviction. He owns 1,400 companies across 23 countries and walks away. Your colleagues love hearing about your portfolio. You have stories, positions to defend, picks to brag about over lunch. Nobody at a grillabend has ever said, "Let me tell you about my MSCI World ETF." It doesn't sound like a strategy. It sounds like giving up. But feelings and math are two different things. Here's what the data actually says, and almost no German retail investor has ever seen it. In 2018, a finance professor named Hendrik Besembinder analyzed every publicly traded stock in the world going back to 1990. He looked at 64,000 companies across dozens of countries. His question: how many of them actually created wealth above the alternative of simply holding government bonds? The answer breaks every assumption behind stock picking. Across global markets, just 2.4% of publicly listed companies created all of the net wealth generated above safe government bonds. The other 97.6% collectively went nowhere. And the same pattern held in Germany, in the US, in Japan, in 55 out of 57 equity markets studied. A tiny number of extreme winners dragged the entire average upward. Everyone else just filled space. Thomas owns every share of every winner from the day it listed. SAP when it was nothing. Infineon after the crash. The next company that doesn't even exist yet. No research required. The ETF does it automatically. You hold 8 to 10 stocks. Even if you pick better than random, and you probably do because you're focused on established companies, you still have to own the next generation of extreme winners and hold them for 25 years without selling. That's the first cost. There are more. Calculator moment 1. The German tax system has a specific cost most retail investors here don't calculate honestly. Every time you sell a winner, rebalance, take profits, rotate into a new position, you trigger the Abgeltungssteuer, Germany's flat capital gains tax of 25% plus the Solidaritätszuschlag. That's effectively 26.375% on every realized gain, applied immediately, before the money can keep compounding. Thomas's iShares MSCI World ETF turns over roughly 2 to 4% of its holdings per year, and the ETF structure handles most of that tax efficiently through internal rebalancing. Your active depot, if you're rotating positions as most stock pickers do, likely turns over 15 to 25% annually. Over 25 years, that tax drag compounds quietly into the background. You never see it on a single statement. By year 25, it has cost you roughly €38,000 in gains that left your compounding engine every time you made a trade. Thomas kept compounding that money. Now here's the comparison that actually shows you what's happening. After 10 years, you're at approximately €87,000. Thomas is at €96,000. The gap is €9,000, small enough that you don't notice because your winners are bigger now, and your losers, the ones you sold and stopped mentioning, don't appear on the statement anymore. Calculator moment 2. By year 25, assuming a 7% average annual return before costs, your individual stock portfolio, accounting for tax drag and an estimated 1.5% annual underperformance from concentration and behavioral costs, reaches approximately €212,000. Thomas's ETF portfolio reaches approximately €248,000. That €36,000 gap is the equivalent of 6 full years of your monthly contributions, gone, not into a single bad trade, but into 3 small, invisible compounding leaks running simultaneously for 300 consecutive months. This is how stock-picking underperformance feels in Germany. It doesn't feel like losing. Your portfolio keeps going up. You have winning positions to point to. It feels like winning slightly less than the market is winning. And winning slightly less for 25 years is how people arrive at retirement with a number that is inexplicably, confusingly smaller than it should have been. Here's what the headlines are not telling you. Between Frankfurt and Hamburg, between Bavaria and Brandenburg, the wealth gap in Germany is already significant. The average net financial wealth in Bavaria is nearly double that of households in Eastern German states. The difference between those two populations is not intelligence. It's not income. This compounding started earlier with fewer friction costs applied to it. The Abgeltungssteuer, the trading costs, the behavioral drag of rotating out of positions at the wrong moment, these are friction costs. And friction costs compound in reverse. The good news is that Germany has made the boring answer unusually accessible. A depot at DKB, ING, or scalable capital costs nothing to open. The iShares Core MSCI World ETF charges 0.2% in annual fees. The SPAR plan, automatic monthly ETF investment, can be set up in 20 minutes and then forgotten. The German tax system even gives you a Sparepauschbetrag, a €1,000 annual tax-free allowance on investment income, which a low-turnover ETF uses efficiently because it generates very little taxable income each year. None of this means individual stocks are wrong for everyone. Inside a well-structured depot, a small satellite allocation, under 10% of your total portfolio, to individual companies you genuinely understand deeply is fine. Pick names in industries you work in. Learn how markets price companies from the inside. Just don't confuse that activity with your wealth-building strategy. The trap is not picking stocks. The trap is believing that picking the right stocks is the goal, when capturing market returns is the actual goal. Every "I bought SAP in 1998" story is told by someone who already knows SAP won. Nobody tells the story of the stocks that didn't. Thomas doesn't have a story to tell at the Grillabend. He has a number, and after 25 years, that number is larger than yours. Boring wins.